Unitedhealth was once considered one of the most predictable compounders in American healthcare. Then the story changed. Medical costs surged. Medicare Advantage became more difficult. Optum Health came under pressure. Earnings estimates collapsed, and investor confidence disappeared. The stock fell from roughly $630 to around $233. But then, the story began to change again. Unitedhealth started to recover. The stock rebounded sharply, and the latest earnings report showed improving medical cost trends, stronger cash flow, and a higher 2026 earnings outlook. So now, the investment question is very different. The stock has already recovered significantly. But has the business? Unitedhealth just got crushed. Is this a rare opportunity? Unitedhealth has already come a long way from the lows. The stock fell from roughly $630 to around $233 as investors questioned the company's earnings power. Since then, the stock has recovered sharply. But this is where the investment debate begins. A recovering stock price does not automatically mean a recovering business. Medical costs remain critical. Medicare Advantage is still under pressure. And Optum must prove that it can regain sustainable growth. So the question is not whether Unitedhealth can recover. The stock already has. The real question is whether the business has recovered enough to justify the recovery investors are now pricing in. To understand whether Unitedhealth can truly recover, we first need to understand the business investors are actually buying. Unitedhealth is not simply a health insurance company. UnitedHealthcare provides coverage to millions of members across commercial, government, and senior markets. And through Optum, the company operates across healthcare delivery, pharmacy services, and healthcare technology. This creates a healthcare ecosystem that is far more diversified than a traditional insurer. And that ecosystem is the foundation of Unitedhealth's competitive advantage. But it also creates a critical question. Can this enormous scale still produce superior earnings growth in a healthcare environment that is becoming increasingly expensive and complex? Unitedhealth's competitive advantage is not built around a single product. It is built around scale. The company operates across insurance, healthcare delivery, pharmacy services, and healthcare technology. That gives Unitedhealth access to enormous amounts of data, extensive provider relationships, and purchasing power that few competitors can replicate. The bigger advantage is integration. The more parts of the healthcare system Unitedhealth operates across, the more difficult it becomes for a competitor to replicate. The core problem was not a collapse in demand. Unitedhealth continued to serve millions of members across its healthcare ecosystem. The problem was the rising cost of serving them. When medical utilization rises faster than expected, the economics of health insurance can change very quickly. Premiums are largely set in advance. But healthcare costs can rise unexpectedly. And when that happens, even a company with enormous scale can experience significant earnings pressure. That is what investors were forced to confront. Unitedhealth had the scale. But scale could not immediately protect the company from an unexpected surge in medical costs. For years, Medicare Advantage was one of Unitedhealth's most important growth engines. But the economics began to change. Medical utilization increased, healthcare costs rose, and reimbursement became more difficult to predict. The result was a painful mismatch. Premiums had largely been set. But the cost of serving members was rising faster than expected. And this is where the market began to question the old Unitedhealth thesis. Was this simply a temporary mismatch between pricing and medical costs? Or had the economics of Medicare Advantage fundamentally changed? The pressure was not limited to UnitedHealthcare. Optum Health was supposed to be one of the most important long-term growth engines for UnitedHealth. But as medical costs rose and the healthcare environment became more complex, Optum Health also came under pressure. This was particularly damaging to investor sentiment. Because investors were paying for two things: the stability of UnitedHealthcare and the growth potential of Optum. When both narratives came under pressure at the same time, the market began to question the entire UnitedHealth growth story. And that is when a high-quality compounder began to look like a turnaround story. This is when the UnitedHealth story truly changed. Investors were no longer asking whether the company could grow earnings next year. They were asking whether the old earnings model could still be trusted. And once confidence disappears, valuation can compress very quickly. The market no longer gives the company the benefit of the doubt. Every increase in medical costs becomes a warning sign. Every weak quarter becomes evidence that the problem may be structural. This is how a compounder becomes a turnaround story. Not because the business suddenly disappears, but because investors stop believing that the future will look like the past. But now, the narrative is becoming more complicated. UnitedHealth's latest results show meaningful signs of improvement. Revenue reached $112 billion. Adjusted earnings came in at $6.38 per share. Medical cost trends improved. And operating cash flow remained powerful. Most importantly, management raised its full-year 2026 adjusted earnings outlook to between $19.50 and $20 per share. This does not mean the crisis is over. But it does mean the business is no longer moving in only one direction. And that changes the investment debate. This is where the investment debate becomes genuinely interesting. The recovery appears to be real. But one strong quarter does not automatically establish a new earnings base. Medical costs can rise again. Reimbursement can change. Utilization can surprise to the upside. And Optum still needs to prove that it can regain sustainable momentum. So the question is not whether UnitedHealth can recover. The question is whether this recovery can continue long enough to restore the earnings power investors once expected. Because a temporary improvement can move a stock. But only a durable recovery can change the valuation of a business. And this is where the potential opportunity begins. The market has already punished UnitedHealth for the deterioration in earnings. It has compressed the valuation multiple. And it has significantly lowered investor expectations. But markets can make a second mistake after the first one. They can correctly identify a problem, and then extrapolate that problem too far into the future. If UnitedHealth's current earnings pressure represents a trough rather than a new normal, then the market may be valuing a recovering healthcare franchise as if its long-term economics have permanently deteriorated. And that is the central question investors need to answer. Is UnitedHealth recovering faster than the market expects? This is where valuation becomes critical. The question is not simply what UnitedHealth earns today. The more important question is what the business can earn when medical cost pressure normalizes. In the conservative case, we assume that earnings power remains permanently lower and the company deserves a lower multiple. In the fair value case, earnings recover toward a normalized level, but the historical premium valuation does not fully return. And in the optimistic case, both earnings and investor confidence recover. The valuation gap between these scenarios can be significant. Because the future value of UnitedHealth depends less on today's earnings, and more on whether today's earnings represent a trough or a new normal. Valuation is not about predicting where the stock will trade next. It is about estimating what the business may be worth under different operating scenarios. In my analysis, I use 3 valuation cases. The conservative case assumes that earnings remain structurally lower after the recent challenges. The historical, or fair value case, assumes Unitedhealth gradually returns to its long-term earnings profile without requiring an aggressive valuation multiple. And the optimistic case assumes both earnings and investor confidence recover over time. Based on these assumptions, my estimated fair value is approximately $330 per share. This is not a price target or an investment recommendation. It is simply a framework for comparing today's market price with different long-term earnings outcomes. Unitedhealth is no longer being judged on whether it can survive. It is being judged on whether it can restore the earnings power that once made it one of America's highest quality healthcare companies. The business still benefits from enormous scale, a diversified healthcare ecosystem, and strong cash generation. At the same time, medical costs, Medicare Advantage, and the execution of Optum remain critical factors to watch. Whether the recent recovery becomes a lasting turnaround will depend on the company's ability to consistently deliver stronger operating results over the coming quarters. As always, this analysis is intended to help understand the business and its long-term value, not to predict short-term market movements or provide investment recommendations. Ultimately, the market will decide the price. But over the long run, business performance is what determines value. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.